Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And all I can say is, yes, he's back. He was certainly missed last Sunday. He was out and about enjoying life with his wife out in Cabo, I believe. But he's back, Mr. Dan Bird. How you doing, sir?
Doing great. A little spaced out. I didn't get in till, well, we didn't get to sleep really until 2 in the morning last night.
Yeah.
Long flight. You lose 2 hours coming from Cabo is mountain time.
Okay.
Basically.
Yeah.
Even though it's on the West Coast, they don't recognize daylight savings time.
Okay.
Kind of like Arizona.
Yep.
So it's 2 hours behind.
Well, I appreciate you making time for this. I know I know my audience. I actually had 3 or 4 people reach out to me going, is Dan coming back? Is Dan coming back? I'm like, he missed a week to, go be on vacation, but yeah, he'll be back. So we missed you. I guess that's pretty obvious.
Only 3 or 4.
Sorry.
I'm just kidding.
I know. Well, I missed you. That's all that matters. So let's catch people up on the market. It's been a couple of interesting weeks.
Yeah.
What are kind of your thoughts on where we're at? What's going on? Because I know I have some questions.
Well, it's I think we're kind of hanging on by a thread right now. Actually, I'll show you a couple of things. I'll show you some charts and where things are right now.
Yeah.
But go ahead.
No, I was going to say my macro thesis which is where I've always played is, we've only done one of the 3 steps to kind of get to a bottom, right? We've had multiple compression, which seems to be almost done.
Mm-hmm.
What we haven't had, and we've just started, right? Micron came out last week. We've had some others. We haven't had earnings compression. Right. And I suspect this earnings season is going to be not necessarily misses, meaning the last quarter might have been okay, but I think more and more companies are going to realize the recession talk, the scary headlines, and take it as an opportunity to lower expectations, right? I have a Wall Street guy on every Monday, Taylor, and I think it is fundamentally ridiculous and upsetting that Wall Street generally still says earnings are up 10% this year and 9% next year. Wall Street analysts are not doing their job, in my opinion. So I think step 2 is earnings reductions. And then step 3, the bottom, is most people have experience with 2020 March being a V-shaped bottom. Like, okay, we hit it. Now we're off to the races. And I'm like, this could be months in the making of a bottom. So I see a lot of pain.
That's exactly right. And I said that last week in my newsletter before I left.
Okay. I
said it will not be a V bottom.
Oh, God. No.
It's going to take time. And I'll show you that in the charts. But yeah, it's going to take time. And interesting the way you frame that, because you said 10% this year and 9% next year.
That's what they're calling for, yeah.
But 9% next year, 9% of what?
Well, what they're calling for.
So companies will lower their earnings estimates just to make sure they can beat it.
Right. But that's, again, my point was analysts have not yet adjusted their expectations. So their expectations of this year earnings are up 10% and then 9% on that.
Yeah,
so
that's not realistic.
No, it's fantasy land.
Yeah.
Okay, we agree.
But I think a lot of companies are still going to be healthy. I think they're going to be okay, and there's going to be layoffs. It'll reduce costs, reduce expenses. That'll help earnings.
Oh, you'll have companies buy back shares. You'll have people increase dividends. I mean, the banks, one thing that happened when you were gone, 4 of the big 6 banks increased dividends somewhere between 5 and 20%.
Right. Yeah. And just like you said, companies will take this as an opportunity to lower earnings projections so they can then beat them.
Exactly.
Next year.
I totally agree. We are in for some pain because earnings reductions into a collapse multiple means we have more downside ahead, in my opinion.
Yeah, could be. We'll see.
Could be.
Remember the markets ahead of the economy. So.
Oh, no question. 6 months generally.
Never forget that. But yeah, when Micron actually had pretty good earnings.
They did. Yeah.
But their forecasts weren't so great.
Nope.
So they lowered their estimates for next year, which brought all the chip stocks down with them. So the question I would have is, are those lowered earnings now built in to the chip stocks?
I don't know. What do you, I don't know. I don't study chips. I don't study any independent sector or even stock at any level.
Yeah, I don't know. I don't know. We'll see. I think that a lot of them fell, you know, AMD, AOSL, a lot of the chip stocks fell because of Micron.
Of course.
But to me, that means they're anticipating that those companies are also going to lower their projections.
I would actually argue, as somebody who used to close books as an accountant, that it would be in their benefit to take the sign to lower expectations, so you can beat future.
That's right. Absolutely. Absolutely. So,
okay.
You want to look at some charts?
Yes, let's look at some charts. I've missed this.
Let me show you my newsletter. I'm sure you haven't had a chance to read it because
I haven't. No, I've been on interviews all morning.
Yeah, I've been trying to wake up all morning. Let me share. Okay, can you see that?
I can. Thank you very much.
All right, this is some excerpts from this week's, the one I just sent half an hour ago.
Okay.
Actually. And happy birthday, America.
Yes.
Tomorrow, by the way.
Happy birthday, America. Yes.
That was that first cartoon I put in there in
trying to get the U.S. economy going in a rainstorm, huh? The matches aren't working.
And running out of matches.
Yeah. Oh no. Okay.
And then the other one on the right, you're lower than volatility. We're going to talk about that. We're going to talk about volatility here.
Awesome. Okay.
There was in my newsletter, I put a whole bunch. I just plucked out a bunch of headlines from last week about it being the worst first half, well, for the NASDAQ ever.
Right.
Or worst first half in 50 years.
Yep.
It wasn't hard to find them.
Yeah.
I think I listed 6 or 7 of them.
Yeah.
So that's what everybody's talking about. And this particular one here was actually an article that one of my subscribers sent to me. And he said, hey, look at this. And then I went back and I put all these arrows in.
Okay.
I went back and looked at which of these years were in secular bull markets and which were in secular bear markets.
Interesting.
So the red ones are secular bear markets. You can see there's a lot more red than there are green. And actually, one of the greens is 2022, which isn't finished yet. But
yeah, okay.
But a lot of these, really bad first halves happen in secular bear markets. There were a few in bull markets too.
Sure.
But second half, in some of these, second half, 1932 was 40% gain. Second half.
Mm-hmm. Yeah.
62 was 16% gain. So
I've seen a lot of these kind of talk track, like basically telling investors, yeah, we had a lot of pain, but the averages say the second half might be better. That's what I think these are trying to tell people.
Yeah. And it might be.
Might be.
Maybe. Like I said, it's a lot of this is going to be baked in by the time we get to the second half. Now, historically, July is the best month of the third quarter.
Oh, I didn't know that.
So,
okay.
So while we may get a brief rally in July, August and September, may still be a lot of pain.
I didn't know that. Okay.
Yeah. I'll show you that here in a second. Anyway, if anybody wants the newsletter, breakpointtrading@gmail.com. Just send me an email and I'll add you to the list. And if you get tired of reading it, just let me know and I'll take you off. No big deal.
There you go.
It's all free, so it doesn't cost you anything.
Yep.
And you can feel free to disagree with me.
Yeah, of course.
Just all my opinions, just educational purposes. I'm not making any investment advice or recommending anything or suggesting anybody do anything, buy or sell or whatever. It's just educational. It's just for fun, really.
Yep. I like it.
All right, so let's look at some of the charts this week. Where did I put them? Okay. So this one I've put up here a few times before. This is one that I noticed the head and shoulder pattern way back in February. And I projected that the target is somewhere down here, 3,700 to 3,800, this range.
Yep.
And that's pretty much where we are right now.
Yeah.
And then Tom Bowley, who I talked about the last time we were on, he also was a CPA like you, and would do work for companies, Fortune 1000 companies, and make recommendations just like you suggested.
Yeah.
You know, bring down their earnings so we can beat them next time.
Exactly. Take a little pain now for a huge gain later.
Right. That's exactly what he did. Yep. So he made a very bold call, and I actually put it in my newsletter.
Yeah. Talked about it.
I think it was 2 weeks ago.
It was.
He called the bottom. He called the bottom right there. The actual low, intraday low, was 36.36.
Okay.
Right in here. So we'll see. So far that's held, even though we went up and we came down and it felt like we're going back down again. We haven't breached that level yet.
Yeah. So Friday's reversal was interesting. Wasn't Friday kind of a soft open and then it reversed in the afternoon?
Yeah. I'm going to talk about that. There's some very interesting things that happened last week.
Okay, cool.
All right. But anyway, this is what it looks like right now. I mean, we'll revisit this and take a look at it. There's a few areas that we need to get through. I'll show you that on another chart as well. Okay. But this downtrend line right here is at about 4,000, 3,950 to 4,000. We need to get through that. In general, we're still trending down.
Yeah.
So we'll see if his bottom call holds down here.
Yeah. Okay.
All right. This next one, this is what I call a sustainability chart. I showed this one, I think, last time we talked.
Okay.
Back in December, the market was going up, but all of these sustainability markers were going down. So consumer discretionary versus consumer staples. So this is growth versus value, right? Or aggressive versus defensive. So you want to see these going up like they were back here, right up until December, as the market goes up. But the market went up in December and these went down.
Okay.
And that was the first clue that we're about.
Would you call that risk off? Is that what that kind of is?
This is big institutions rotating. This is rotation is what it is.
Rotated. Okay. All right.
So they're rotating out of growth or aggressive sectors into value and defensive sectors.
Okay. That makes sense.
And most retail traders don't know that they're doing that because all they know is the market kept going up.
They look at the top. Yeah.
Right.
Okay. Gotcha.
So all they knew was the market was going up in December, but as that was happening, all these big institutions were rotating out of the growth areas and into the defensive areas.
Interesting.
All right. So you see that divergence?
I do.
Divergences are really important. I always look for divergences between the internals and the actual market. Okay. So you can see it pretty clearly in December. That was the signal that the market was about to roll over. Okay. And have a prolonged downtrend period because these institutions can't do things that quickly. It takes them months to finish that rotation. So sure enough, the market started going down and all of these sustainability indicators started going down as well, which means institutions were continuing to rotate out of growth and into value, out of aggressive and into defensive. Okay. All right. They're continuing that process. These vertical red lines here are the close. This is the lowest close before this little rally. All right, that's how I identified the ranges here. Okay. This is the lowest close. We had a rally and we went back to a lower close than this. This was the lowest close before this rally. This was the lowest close before this rally. Okay. And you can see in all those cases, all of these sustainability indicators continue to go down. Okay. Until we get to here. And we went down again. The market went down to another lower close. Right. However, the sustainability indicators started going up.
Interesting. Okay.
So that's our clue that institutions are starting to rotate back into aggressive or growth sectors.
Okay.
All right. Now, again, they can't do this all at once. It takes some time to do it. Now, the last time I showed this, I had these uptrending green arrows underneath these sustainability areas. So this is the NASDAQ versus the S&P. This is the NASDAQ 100 versus the S&P 100. This is Russell growth versus value. This one here is small cap growth versus small cap value.
Okay.
And the one at the top is consumer discretionary versus consumer staples. So things that we would like to buy or want to buy versus things that we have to buy. Right?
Okay. Yeah.
I took the green uptrending arrow off of this one.
Yeah.
Because it actually came down and it touched this low right here.
Yeah.
You see that?
I do.
So that's the first one that I've removed the arrow from.
Interesting. Okay.
It's actually started as of Friday, started to creep back up again. And what our hope is that it will continue to go back up, and this will just be a support area. But we'll have to wait and see what happens.
Okay.
And then if you look at the actual market up here, this was the low that Tom Bowley called right here.
Okay.
We went up, came back down, and then we started back up again on Friday.
Okay.
So we'll have to see if this is a higher low. And that's what we want to see to determine if we're actually out of this long downtrend period. We want to see a higher low and a higher high. So if this becomes a higher low right here, we need a close up here above this one. And this is why I said the recovery won't be a V recovery.
Oh, yeah.
We've got a lot of
Choppiness.
upside resistance to go through.
Yeah.
Now this kind of light green line right here, this was the low, the low close before this rally, but we haven't closed below it yet.
Yeah.
So as long as we stay above it, and if we keep on going up, then this will become a solid green line.
Got it.
If we go below it, this will be another one like these over here.
Yeah.
Solid red line.
Yeah.
Okay.
All right.
All right. So a little bit of hope, but the jury's still out.
Right. Okay.
This is the one that I showed that shows the three components that all happened at the same time. And it's only happened twice before this, where the put call ratio has gone above 88, meaning there were more puts than calls, meaning more people were bearish.
Yeah, negative.
Bullish.
Yep.
All right, down here, the VIX was above 30. And the percent of stocks above their 50-day moving average was below 10%.
Wow.
All three of these things happening at the same time has only happened 3 times in the last 5 years. Once in 2018, where we had, and this is the S&P and this is the NASDAQ in blue here. In 2018, we had a correction.
Yep.
The COVID crash, of course.
Yep.
And now.
Interesting.
So only 3 times has all 3 of these things happened together.
Okay.
Again, the jury's still out, but last time I showed this number circled here, this is a percentage of stocks below or above their 50-day moving average. Last time I showed this, which is right near the bottom here, this was at 2%.
Oh, wow. Now it's 24.
Which means only 10 stocks out of the S&P 500 were above their 50-day.
Okay.
Now it's at 24%. So about 120 stocks out of 500. So this is marked a bottom before. We'll see if it's marking a bottom again.
I like it. Okay.
And then the NASDAQ 100, this is 27. I think it was at 8. So 8 out of 100 stocks. Now there's 27 out of 100 stocks.
Okay.
All right.
Yep.
So next I want to talk about the VIX, because that's something that was strange that happened last week. Just like you said, there were some interesting things going on.
Yeah.
So first I want to talk about what the VIX is. The VIX is called the volatility index. And it's something that the CBOE puts out there. It's known as the fear index. So it's the volatility of options 30 days into the future. And that is really, really important. Volatility, market expectations of volatility over the coming 30 days.
Yep.
It's not telling you what's happening right now.
No.
It's telling you what the market thinks is going to happen over the next 30 days.
Okay.
And it's based on the number of puts and calls, volatility of the options market that traders are making. And, options are time sensitive, right? You buy and sell options based on some future date. So that this tells you what the expectations are over the coming 30 days. Now, the VIX generally rises when stocks fall and declines when stocks rise. Okay. And that's pretty standard. That's pretty much how it works. The VIX usually goes up when the market falls, and it goes down when the market rises.
Okay.
All right. But what happened last week? Here's the VIX. This one in the center right here is the VIX.
Okay.
The VIX was falling, and so was the market. That's not how it works. If the market's falling, the VIX should be rising.
Okay.
But it didn't.
No.
It fell instead. In fact, look at this Friday candle.
Yeah.
So what is that telling us? What is the VIX trying to tell us? Remember, it's volatility 30 days in the future.
I don't know. Is the VIX telling you that a bottom is near?
Well, I don't know if it's saying that a bottom is near, but to me, it's saying that the expectation is that a rally is near short term, the next 30 days, in the next 30 days.
Interesting.
July. So the month of July, what the VIX is trying to tell us here, because it's a future.
Yeah, no,
most indicators are lagging indicators. The VIX is a future indicator.
Interesting. Yeah. So help me understand that. I was just guessing earlier. So why do you think so? A VIX falling and the market falls. Okay, so the VIX is a future indicator. You just said it.
Right.
So when the VIX falls, it's not telling you what happened today. The market's down. It's telling you what may happen in the future.
The expectations on the next 30 days.
Okay. All right. Yeah.
So if the VIX is falling, that means there are more traders buying calls.
Interesting. Okay.
Because traders think that there's going to be a rally in July.
Yeah. See, I've never really looked at the VIX. For me, the VIX has always been that one, daily indicator that marks a washout, right? When it hits 40 or 42 or whatever. I've never looked at the VIX this way. So this is brand new information for me. Thank you.
Right. Yeah. And that's true. If it hits 40, then that's usually the time when everybody is fearful.
Yeah. Capitulation.
Everybody's selling, whether they care or not, whether they think it's going to go up or not. They don't care.
Sell. Yeah.
They're panicking and they're selling everything if it hits 40.
Yeah.
But keep in mind that the VIX is 30 days in the future. Yeah.
That's new information. Thank you. That's cool.
Right. This is a VIX chart that I look at quite often. And the way I put this together is these are moving averages. So there's a 5-day, which is the red, a 21-day, which is the green. That just helps me visually see what's going on. Okay. The gray in the background is the actual number. It's not a moving average, it's the actual number. Okay.
Yep.
So right here, the VIX hit 34. That's pretty high.
Yeah.
And if you follow that down, it's right down here at the bottom where the S&P was.
Okay.
S&P is down here in this lower panel.
I see it.
So whenever this moving average goes up and whenever the VIX spikes like that, it turns red. And that tells me, especially when the gray starts to move past the red down here, that's usually a top. That's when things are about to roll over and start going down. And likewise, on the other side, when the gray starts to come back down and cross over the red, where I have this vertical green line, that's usually near the bottom. You can see it was right here. Now, if the market is continuing down, which it did last week, this has not turned red yet. The VIX is not going back up.
Right.
The VIX is still falling. This is a little bit of green here. It's actually, the green is actually accelerating. You can see it on this right-hand tail. So again, the VIX seems to be telling us that we may have a rally in the short term. So we'll see.
Okay.
And then this is just something from Stock Traders Almanac, where they look at historical information, and that's why I say, historically, there's a 12-day period between June 28th and July 14th when the market rallies.
Oh, didn't know that.
And they go back to 1900. They look at dates all the way back to
Wow.
1900. Now this is the NASDAQ, which only goes back to 85.
Okay.
But historically, that doesn't mean it can happen this time.
Sure.
But historically, the market rallies between the 28th and the 14th. So we're really just starting into that period right now.
Mm-hmm.
Now, what is July 14th? Do you know what the importance of that date is?
Well, July 14th is the first date of earnings from banks.
Mm-hmm. What else is it?
Is that Fed Day? I don't know what that is.
No.
I don't know what 14th is.
CPI.
Oh, CPI comes out on the 14th?
Yeah.
Ooh, that's going to be good. Wow. Okay.
Yeah, very interesting, huh?
Huh. Yeah. Yep. Yeah. I think what was it? What do we know what expectations are? Are people expecting it to go down this time? I don't know.
I don't know. I haven't actually looked at that. Last time they did and they got burned.
Yeah, exactly.
Right. So I have a feeling that they're going to be a little more reticent this time.
Yeah, more cautious. Yeah.
So they might, they might actually think it's going to go up. I don't know, frankly. I couldn't tell you. It could go up, it could go down, it could do nothing, stay the same.
I'm going to type it in right now and see if we get anything. So that would be July 14th. Let's see. Anybody willing to call a guess? I don't see anything right now. Yeah, I think
it has a chance of going down a little bit, actually.
Okay. Yeah. Yeah. I think we get peak inflation one of the next 3 months. That's what I think happens.
Yeah, I think you're right. And could have been last month.
Maybe.
Some of the things that make it up are starting to go down. Last time we talked, I showed you core CPI versus actual, headline CPI.
Mm-hmm.
Core CPI strips out energy and food.
Yeah.
And that actually started going down last time.
Yeah, it's funny you bring that up because I just talked about PCE. I didn't do it with CPI, but
Right.
PCE has the same headline versus core.
Right.
And there's the largest gap in 22 years between headline and core at 1.6. And that eventually is going to be a problem for the Fed because you can't keep talking about core when you have food and energy and rent all screaming higher.
Yeah, that's right. So I don't know. We'll see. It'll be interesting. It will be an indicator of what the Fed does in their next meeting, which is, I think, the week after that.
Yeah, it's the 23rd, I think. Yeah.
Right.
Yeah, the Friday.
So, last time they said maybe a half and maybe 3/4. Well, that number on the 14th, I think, is going to tell them which one they're going to go with.
Oh, yeah. Let's just put it out. I mean, if CPI would probably have to be sub 8.2 for them to do anything less than 75.
Yeah.
It would have to be a substantial drop.
Right. Well, it would have to be lower than the low from 2 months ago.
Yeah, which was
8.3. That was 8.3.
Yeah. So it would have to be below that. Agree. That's exactly how I got to that number.
Yeah. Yeah. And then this is the one I showed you before from Stock Traders Almanac.
Mm-hmm.
For those 12 days in July. And what they said was NASDAQ mid-year rally had a spotty track record from 2002 until 2009 with 3 appearances and 5 no-shows in those years. And as I always do, whenever I see statistics like this in any article, I want to know, were those years secular bear markets or were they in secular bull markets? And it turns out they were secular bear markets during those years.
Yeah.
Right.
And again, your call is we are in a secular bull, but a whatever the other one is.
Cyclical bear.
Cyclical bear, right?
These are the secular bulls going back 100 years.
Yeah. Which
usually lasts about 20 years, and we're only about halfway through this.
Okay.
All right. So that's interesting little point. I always like to do that whenever anybody sends me an article that says, hey, look at this, worst time ever.
Yeah.
These are the years where things were really bad. I'm like, yeah, they were secular bear markets. They're
supposed to be bad. Yeah. It's kind of the definition.
And this is also from Tom Bally. He provides interesting insights like this. This is, again, going back to 1950,
Hmm.
historically what those first few days of July look like,
Oh, is that what that is?
which is this big one right here.
Hmm.
And these are up until the 6th, which is next week,
Gotcha.
basically. So this is
Yeah.
next week's period.
Okay.
So that's where we are. It's still, like I said before, it's iffy.
Yeah.
We're kind of living on a razor's edge right now.
Yeah. Okay.
We could have put the bottom in, but next week I think we'll tell.
Very cool.
And the next CPI number I think is going to be really important.
Yeah, I don't think we get any meaningful earnings until the 14th.
Right. Yeah, that's when it's going to start.
Yeah. So next week I think is pretty.
And summer is hard anyway. July is the best month of the third quarter usually.
That was something I didn't know. That's cool.
So we may, we're still going to struggle. It's not going to be a V bottom. We're going to bounce along the bottom.
Yeah.
We might make a double bottom. We might go back to that bottom that Tom called and then go back up from there.
Maybe. Yeah.
But it's not going to be, smooth sailing.
There's no V-shaped recovery in this one.
Right. That's right.
You want to show your email one more time? Yep. Folks, if you're listening on the podcast, it is breakpointtrading@gmail.com. Thanks, buddy.
And the next one, we'll do a short one. I just want to talk about how to repair a failed trade, and
Awesome.
something that I'm actually working on because I have a failed trade. So
awesome. Thank you, buddy.